Much has happened in the last week since we most recently met. Let's look at creating a virtual playbook for the remainder of 2020 and ask the question in our playbook, is this distribution or reaccumulation? Hi, my name is Bruce Frazier. I am your host, and this is Power Charting. Now, I'm recording this on Thursday. On Saturday, there's going to be the TSLA SF conference. This is a all-day virtual conference that is free for all members. Membership is inexpensive. It's a wonderful organization. The officers have lots planned for the remainder of 2020 and into 2021 that is going to, I think, make for an exciting number of months and year ahead. But look at this great list of speakers for Saturday. Now, if you hear this on Friday, you can still sign up. If you are seeing this presentation after September 12th, you can still become a member and listen to the recording. So you have complete access to that going forward. Okay, moving on, Tesla. This is a blog that was done. Also, I talked about this on video. I'm only going to spend a minute on it. There's an interesting principle in point and figure that we can take advantage of here. You can see that there was a very large point and figure count. Now, this is a vertical chart, not a point and figure chart. Go to the blog on August 23rd to see the point and figure. This count goes all the way back into the middle of 2017, and it counted up to the extreme count of 1875 to 2005. There's been a 5-for-1 stock split in Tesla, so the price has been adjusted. So let's zoom in here, and you can see that the updated chart has the adjustments of the price. Well, 2005 was thrown over in the extreme momentum of the upward move in Tesla, where it approached and touched 2,500. Now, that can happen in point and figure analysis, but it was a momentum surge that produced this. We'll notice what has happened since. The price of Tesla has now fallen back below. Now, these obviously are not adjusted for the stock splits, but you can see here that the price has fallen back below the count objective. And so now what does this mean? Well, first of all, this extreme momentum has produced a overbought condition. The point and figure chart suggested that this was the objective range that was available. It threw over and came right back. That happens all the time. So now we have an extremely wide range-bound condition with an overthrow and a reversal, likely going to have a range-bound market for some period of time in Tesla as it consolidates and either builds a cause for another move up or possibly distribution for the move down. So very interesting chart, something for us to keep an eye on. Also, the idea that there is a much bigger count potential, possibly going all the way back to 2014. Wow. So with that, let's move on. I want to talk a little bit about distribution. Distribution schematics in this case, we're looking at one with a somewhat of a rounding top formation, and you can see the ever increasing volatility as distribution forms over time. This is an attribute of distribution, is that there is wide, crazy swings as stock is being distributed from strong hands into weak hands, ultimately concluding with the completion of distribution into markdown. So you can go back and look at this blog to look more closely at these schematics. This is a classic rounding top type structure with the last point of supply that concludes the advance. Now here is an upthrust after distribution, and we see this often, especially in strongly uptrending markets. So here this upthrust goes to a final new high, captures or traps all the momentum traders as it breaks out to a new high, and then quickly fails into a long decline that goes down to the support area of the distribution structure, pauses there, and then fails into a phase E markdown. So these are our two primary constructs. There are principles at work in each of these phases as you go through distribution, just as the case is for accumulation. So we want to just keep in mind the principles at work. The structures can look different. Each structure is unique in its own right. We always function on principles in Wyckoff. Here is a case study. This is coherent, and you can see that there is climactic surges here with a preliminary supply buying climax, continues to be in an uptrend. This is a pernicious aspect of distribution, as often distribution occurs on a rising scale as prices continue to go up and make new highs. So this is lost on many people, that especially because of the sheer momentum of the upward trading, but distribution is taking place throughout. So you have higher highs and you also have lower lows. When the upthrust after distribution is complete, you have this very sharp decline back down to the support area, as we just talked about in the schematic, which you can see on the right. I say here, respect the UTAD. Well, what happened after that? So you can see here the trend channel and the break of the trend channel. And this is going to be relevant to the current market structure we're going to look at in a minute. Here we can see that after the pause at support, there was basically a flat period and then a decline into a new downtrend. This is the markdown phase. And so this is a very tricky distribution. Is a tricky business, but we want to look at as many case studies as we can. Keep this in mind as we go forward, because we're going to look at some recent examples. Now, here's the distribution versus reaccumulation paradox. We're asking the question, is this distribution or reaccumulation that is unfolding here on multiple time frames? So you can see that you stop an upward trend with distribution with a buying climax and an automatic reaction, range bound state. I should actually be using a highlighter here, and you can see the buying climax, automatic reaction, support, resistance, and here is that pause that occurred that we just saw in the coherent example. In the case of reaccumulation, well, this is the paradox. You get the same thing. You have an upward trend. It is stopped, and it is stopped by an acceleration into a climax. Thereafter, you have a larger than average decline. This is an automatic reaction. Support is drawn under that, resistance above the buying climax, range bound state. But notice the difference here, typically, is that there is a diminishment of volatility through a reaccumulation, because stock is being absorbed by the composite operator, by large informed interests that are expecting a new uptrend to occur. I love reaccumulation structures. These are great opportunities to position stock for, or the market for, important continuation of the uptrend. Well, in distribution, the volatility grows ever larger, and that is a sign that stock is in ever weaker hands. So we will do more and more analysis of this kind of these kinds of structures as we go along. I'm going quickly because I have way too much material to cover, and I'm going to cover it, darn it. So here Here is an intraday 2-hour Dow Jones reaccumulation, two reaccumulation structures, rally up into a buying climax, then an automatic reaction, range bound condition, and you can see here that there was an upthrust of sorts. Still looks like it might be distributional to this point, but then notice what happens is that after a touch of support, a spring type action here, that there's a series of very constructive rallies and reactions where the reactions are very dull and quiet, volume is drying up. This is the evidence or shows the signs that absorption is occurring, is completing, a new uptrend is forming. So here is another example here, smaller in size, similar in construction. This is it, we're blowing it up. This is a 60-minute chart. Rally into a buying climax, automatic reaction, range bound state, attempts to go down to support. Look at the volatility coming out of the Dow here as it approaches the completion of a last point of support, then a test of that support, and then a rally. And this is a really good tell right here. Here's another good tell. Absorption is taking place in near completion. When you get all of the stock absorbed, the uptrend begins again. So there are two examples of reaccumulations. You can study those by going back and reading my blog. Now I'm going to change gears here a little bit, but I want to circle back to what we just talked about here in a minute. And that is that this is the seasonality pattern for US presidential election years. So this is 116 years of data all summed together. We've talked about this chart in the past. I want to thank Seasonax for permission to use this chart. I also want to show here, as we talked about last week, that the month of August was a wickedly good month in the election year cycle. Well, it was a great month in 2020. So very important advance, the most important advance of the year. Notice how it concludes with a climax. So now we have what appears to be potentially a range-bound structure ahead of us. I'm going to show you a real live chart, or not real live, but up-to-date chart of the market so that we can see what has happened since that climax was clocked in last week. And we talked about it in the last episode. Okay, so here we are. We're asking the question, is this going to be reaccumulation or is it potentially distribution? This is a very cool chart that my teaching partner, Roman Bogomazov, put together, and I asked him if I could use it, show it to you. I think of us being in the classroom together, and I think this is a very exciting chart. This is the 2016 S&P 500 using the futures daily data, and here you can see that we have the 2016 period on top and the 2020 period of the presidential election years, last time and this time. Here we can see that there's a family resemblance. The all-time high back in 2016 was actually off the chart here to the left, but notice that there was an important reaction from the end of the year into February. Well, we know about the very important reaction that happened February, March of this year. These are the two pink boxes. Then there was a rally, the rally into February, March of 2016. Well, we had an important rally off the lows, and then a consolidation period formed in both of these structures on the S&P. This resulted, these are reaccumulations. So reaccumulations formed, and then you had a continuation of the uptrend. This is the very important on the lower chart, this green box is the very important rally in July, August. Very good rally in July, August in 2016. So here we are now, and recall what we just looked at on the seasonality chart is that there was a climax here, and now we're having a reaction, and it suggests, well, let's just go back and look. This suggests that we're going to have a reaction into the middle of October, and then a rally to a minor new high, and another minor new high in early and late November, right into the election, and then another new high into the end of the year. So here you can see that there was a consolidation. Actually, the low was made in early November in 2016, and then the market rallied into the end of the year and made a new high. And here we're wondering what this structure is going to look like. I think that the difference between the 2016 election and this time is that the outcome in 2016 was really, I think, very unexpected and a surprise. This time, I believe that there's the expectation of the marketplace is that it could go either way, and that there's an expectation that it's about nearly a 50-50 proposition about which party is going to win. And so I think that the consolidation period may have a different look to it this time. Now, again, switching gears again, let's look at the put-call ratio, only because we talked about it last week, and here I had said on this green line, which is the 10-day moving average of put calls, that there was extreme call buying activity all the way back to June, really record call to put activity, very low ratio, extreme bullish speculation, even more so than the record setting period of January, February, and that we would look for the 10-day average to turn. That happened this week. We can see this big jump in the daily data of the put call ratio, but now we're starting to see the 10-day. I think the 10-day is the ratio average to look at. The question becomes, how high does this 10-day average need to go to create enough bearish speculation, enough bearishness, enough put buying to be able to end the reaction in the stock market. So we're going to watch this closely, but now this 10-day average is pointing up, which means that put buying is on the increase. Here is the NDX chart that we looked at. I actually put this in a blog over the last weekend, so please go in and look at that chart. You can make it active and bring it up to date. This chart is into today's trading, and you can see here an important trend channel. The solid gray line is what we call the demand line. The overbought line, which I always put in as a dotted line, is the overbought line is the parallel to the demand line. Demand line is made on 2 points made early in the uptrend, and then the intervening high on the overbought line is where the parallel goes. So here's our late August, September climactic surge. We talked about this last week, and then there was a reaction off of that at the day of our last get together in terms of the recording the video. But now we've had a very sharp decline, which we would expect off of buying climax, all the way down to the demand line. So throw over, overbought condition, reverses down, and look at the extent, the speed with which the decline has occurred. Automatic reaction goes right to the channel, and now it's attempting to bounce. We're going to look at the quality of the bounce, but we would expect that the bounce would come up probably into the mid part of the range, could go even higher. I've seen them bounce all the way back up to the buying climax. And the expectation here is that resistance at the buying climax, automatic reaction low as support, this is going to represent the range bound condition for this market for some period of time. So this is an important change of character. This is an abbreviation for that, because look at the extent, the size of this reaction compared to the ones that preceded it. Here's a beautiful reaccumulation, by the way. See, this is why we really like to focus on these. Notice the higher lows, the diminished volatility, the mild reactions as prices rose, and then once it cleared the range of the reaccumulation, look at the persistency of that upward trend. This is a really important circumstance for the NDX, and we'll keep a close eye on that. Here, I just want to point out the bullish percent as a breadth indicator for the NASDAQ 100. We talked about this multiple times in the past. Series of lower highs in the bullish percent index shows diminished participation by the 100 stocks in this index over time. That's just a sign of the breadth deteriorating as it's going up. And you'll notice that with this dramatic last run up in the, this is the S&P 500 actually, but the NDX, that it goes to a lower high. So really it is dominated by the stocks that are representing the FANG, the really big market cap stocks, which are also in the S&P, by the way. And I had said that until it broke below that 55 to 50 level, that you didn't really have a condition that you could call a vulnerable condition for the index to really break. Well, look where we are. We're now below 40, we're below 50 at 44. So this produces somewhat of a vulnerable environment for the NASDAQ 100. Here's the S&P 500. This is an upward trend. And in this upward trend, you can see a trend channel. This is a 60-minute intraday chart. This is the chart that we looked at last week, a week ago, when I was recording the last power charting. So you can see different construction. This is a reverse use of trend lines where the primary trend line is now over the market, drawn on these points here, and then the parallels drawn underneath. So very cool technique. Oftentimes it's the better technique to use. Buying climax, automatic reaction. Well, what happened since? Okay, so this is what happened since. Now there has been a break of this trend channel decisively well below it, and it really is comparable to the break that we had in June, which created at the time, and we talked about this then, this large break, that this set up a range bound condition in the S&P 500, and that's exactly what we got. But notice reaccumulation structure right away, higher lows, higher highs, and becomes very dull, quiet into the conclusion of the reaccumulation. And so this has produced a nice uptrend. We don't know what's going to happen here. We do know that we have somewhat of a range bound condition. And this appears to be something where it should go sideways. Distribution, reaccumulation, we don't know yet. And so we will be watching this closely. These two shaded areas are the point and figure counts that were taken, and I showed these last week. I'm not going to show them today, but I'm showing you the objective range that formed, and you can see that it went right into the objective range as defined by these shaded areas on a point and figure chart that we looked at, or we created in a prior episode, and it went right into that area. Two different count areas. The two different shades represent two different count areas: a base in February, March, and then a reaccumulation after that, which is this reaccumulation period that we're looking at here. So counts fulfilled. So we would expect a correction of sorts after fulfilling two important point figure counts. Here's the S&P 500 bullish percent. You can see that in the case here that there is a deterioration of the bullish percent throughout. Look at this extreme acceleration, climactic in the index and a lower high, divergent characteristic being made. Now, what I think is bullish here is the fact that you're making a series of higher lows in the S&P. And so I'm really of the mind that this might be indicative of a reaccumulation forming for the S&P 500 after we form reaccumulation over here, if in fact that's the case. And here, actually, here's the Dow chart for this area. Okay, so this is the accumulation, reaccumulation area, and these are the counts, and we're fulfilling these counts now. Here's the high that was made in the Dow at around 29,200, and this fulfills these two counts. Okay, so now we're going to talk about distribution on a larger scale here in the time that we have left, and I am going to take a minute, pause, and get my voice back. Now, I am concerned that this structure going back to early 2018, very large multi-year structure, is potentially distribution. Go to the prior episode to see more on the big cyclic structure of the entire bull run from accumulation uptrend to distribution. But here, this is the concern that I have, and I want to show you this. Let's do the highlighter here, and I want to show you what has happened is that in this area right here, where we have defined by the buying climax secondary test, throw over at the upthrust. I'm calling it an upthrust after distribution. I am also going to show you a bullish case here if I have time, is that we have now rallied above this trend line and now are back below it. And so we're going to watch this very closely to see whether or not there is continued weakness off of this trend line. This is the structure that I'm concerned about. You can see the broadening formation, higher highs throughout, lower lows throughout, and then there comes this moment where, in this case, there was a rally up to this trend line, which actually goes right through here, and then a failure. And so we're concerned that this was what could be going on, even though I'm not suggesting that this is the expectation, it's just a concern. And so here's the Vanguard Value ETF. These are all value stocks, large cap. Notice this. Here's the 2018 January peak, and here it's a horizontal trend line. It's gone right to this level and now is flirting with coming back into that channel. This looks even more distributional, and this is a value index. And so these are our concerns. Now, here's the bullish case. Here is and you can read this in a March 23rd blog, where were you in 62? So here's the broadening formation. And at the time, we were right at the shakeout. It was the perfect time to write this blog because subsequently there was a tremendous rally off of that period. And you can see here that the rally after reaching the prior highs has taken off, and there was a huge rally that took place after a pause. I'm wondering if we're right here. So with that, gotta go, and we'll talk more about this next time.